Greed and fear. Greed and fear are more important emotions in the world of investing. Greed, a tendency to accumulate more number of stocks of a company as the share price falls, usually in a bear market. Fear, tendency to sell the stocks of the company with an uncertainty of sudden fall in the share price, usually in a bull market. Fear of greed are the worst emotions to feel when investing, and it is better not to be guided by them. SEBI stands for Securities Exchange Board of India. It is incorporated in 1992. It deals with the overall development of and regulation and supervision of stock market. It's also called stock market watchdog. SEBI consistently tries to lay down market rules in line with the best market practices. It enjoys vast powers of imposing penalties on the market participants in case of breach of rules and regulations. For more insight, you can log on to www.sebi.gov.in. What is a depository? An institution with a similar functionality of a bank deals with the deposit and transfer of securities such as shares and debentures. Depository can be compared to a bank where banks hold your cash, where a depository holds your shares. The depositories carry over their functions through what is called a depository participants. In India, there are two depository participants called CDSL and NSDL. With them, you will hold your Demat account. What is dematerialization? Initially, when share buying used to happen, you used to get a physical certificate of your stake. Now these things are fading. Now everything is in the electronic form. So dematerialization is the process of converting physical shares into electronic form. These are credited to your depository participant account, that is Demat account. When you buy and sell shares, your Demat account is either debited or credited from this account. What is the role of primary market? Primary markets are divided into two types. One is primary market, other one is secondary market. Primary market is a market where first time new securities are listed. This is for the companies which want to raise the capital from public for the first time. Government and corporates raise capital to meet the requirements of investment or financial requirement. Issue of securities in the form of equity or debt at face value, discount or premium. Example, IPO, initial public offer. What is a prospectus? A legal document to be filed by companies to SEBI which talks about their upcoming issue. That means it provides the details of investment offering for sale to public. Contains the facts that an investor needs to be informed for making an investment decision. Two types of prospects. Preliminary prospects includes most of the details of the business and transaction. Final prospects contains finalized background information including details as through exact number of share certificates issued and precise offering price. What is an initial public offer? IPO. You keep hearing about this and reading about IPOs in the market in the newspaper. Initial public offer is the selling of securities to the public in the primary market for the first time. This is a process by an unlisted company makes either a fresh issue of securities or an offer for sale of its existing securities or both for the first time to the public. This gives an opportunity to invest and trade in the company's shares by the public. For example, Monte Carlo Fashions came up with an initial public offer of 54.33 lakh shares in the market. What is meant by secondary market? Once the shares gets listed in the primary market, then it can be bought and sold in the secondary market. A market where securities are traded after the processing of listing with the stock exchanges are called secondary market. Majority of the trading is done in the secondary market. Secondary market comprises of equity markets and debt markets. Even there is a secondary market for debt instruments. For example, buying or selling of shares through BSE and NSE. What is peaking out and bottoming out? Bottoming out. A phase when the continuous fall in the market ends and the market tends to rise. Usually, in a bear market, share prices starts going down day after day, and there is a point in the in time where all the stocks are expected not to go further down and it starts going up. That's the time when it is considered as bottoming out. The rise in the market after the fall during 2008 crisis can be referred as bottoming out. Peaking. It's just opposite of bottoming out. When the markets move higher and higher and there is a point when the people feel it is overheated and they start booking the profit and the market starts coming down. Traders when start selling to book profits so the price does not rises beyond this level is called peaking. What is a contract note? It's very important to know when you buy and sell securities in the market, your broker issues you a contract note. A contract note is a confirmation of trades done on a particular day on behalf of the client by a trading member. It imposes a legal enforceable relationship between the client and the trading member with respect to purchase, sale and settlement of trades. It has a prescribed form by SEBI and it contains your trading details, that the number of shares bought or sold at what price, securities transaction traded, the charged service tax, all put together, brokerage, everything in the contract note. It will be duly signed by an authorized signatory. After every trade, you need to see your contract note whether whatever your intentional buy or sale has been carried out according to your instructions. Contract note gives all the information related to that. Let's move on to what are the types of orders placed in a stock exchange. When you want to buy a share, you can instruct your broker to buy at a different price level. Number 1 is called market order, number 2 is called limit orders, third one is stop loss orders, fourth is good till cancelled orders, and fifth one after market orders. Let's look at what is market order. When you want to buy a share, for example Infosys, at current market price, that's called market order. Market order is an order to buy or sell a stock at the current market price. It signals broker to execute the order at the best price currently available. However, as market prices keeps changing, the market order cannot guarantee a specified price. Suppose you instruct your broker to buy 10 shares of Infosys at 2,500, you may end up buying in 2,470 or you may end up buying in 2,600, because whatever is available at that time in the market, it will be taken. For example, we place a buy or sell order for ICICI at Rs 345, which is the current market price, but the order can be executed at Rs 345 or a price higher or lower, that is 344.50 paisa or 345.50. So there is no guarantee that your intended buying or selling price is matched in the market and you get at the same price. This is the screen which can be displayed when you are punching your order. NSE, BSE, when you are buying a stock, you have to see buy order, buy or sell on the left corner. Now you have to select the exchange, whether BSE, NSE. Now order type. Here you can see market order, limit order, stop loss order, good till cancelled order, etc. So you need to select market order. You have to give the script name, you need to specify the quantity you want to buy, then you have to give the price, and then you have to give intraday or delivery instructions. Then you need to submit, it will ask for the confirmation once again. Then once you confirm, orders get executed. You need to be extra careful when you yourself is punching the orders in this way. What is a limit order? A limit order is an order to buy or sell a security at a specified price. As you see the limitation of market price order, you can't get the price what you are intended to buy or sell. In the limit order, this is overcome. You can take the help of limit order to get the price you want. It helps in executing the shares in a trade at a single price. You can specify a price through limit order when there is an opportunity for this order to be matched in the market, it is bought. It guarantees the price but not the execution of the trade. For example, a trader places a limit order of rupees 100 shares of a company at rupees 100, but at the time of placing the order only 20 shares are available, so first 20 shares gets executed and the limit order continues. Whenever there is an opportunity next, in different chunks it gets executed. So there is no guarantee that all the 100 intended shares gets executed on the same day. If the price is matched, your order gets executed. This is the screen which is displayed when you are buying a limit order. So all that you need to do is that order type you need to select as limit price and specify the limit price. What is a stop loss order? Stop loss order is one which is placed at a price along with a trigger price. Once the market price reaches the trigger price, orders gets activated. Trigger price can be higher or lower than the current market price. It works very well in limiting the order. Stop loss can save your portfolio from heavy losses. You can buy a stock at rupees 10 and place a stop loss order when it reaches 8. That means you are not sure whether stocks are going to go up and you have a fear that your stock may come down drastically down. And you don't want to wait till it reaches 5 or 3 rupees to lose your capital. You will specify through stop loss order, say that my stock, if it reaches 8 rupees, then it has to be sold. So this is the advantage of having a stop loss order. This order can be used very usefully, limiting the losses. This is the screen which gets displayed when you are wanting to place a stop loss. When you want to sell, you need to select the sell. You can see the color difference. When there was a buy, the screen was blue. When you are selling, it is red. So different broking houses software will have a different color coding, but normally buy and sell will have a different color code. Now you need to select stop loss order, you need to give price, and you also have to specify trigger price. So in this case, price at which you have to sell your stock is 2983.80, whereas you want this order to be active from the time stock reaches 2988 itself. Now, what is good till cancelled order? Good till cancel or day orders are orders given to the broker that holds good only during the trading day when the order was placed. If the order has not been executed on that day based on your specifications, it will get cancelled and you need to give a fresh order to the broker for buying or selling. There are orders that are only good until it is cancelled or good for the day. Example, a trader places GTC order for the buy of SBI at rupees 300 when the current market price is 310. Similarly, on the same day, stock price has not reached 310 at all. So in that case, good till cancelled order gets cancelled. And you need to give a fresh order to the stockbroker. What is immediate or cancel order? An immediate or a cancel order allows a trading member to buy or sell a security as soon as the order is released into the market. In case order failed to fulfill the quantity you specified, it is removed from the market. That means you want to buy right now. If it matches, then you get it, otherwise it gets cancelled. Partial match is also possible when you have specified 100 shares at specified price. Only 10 shares are available and 10 shares gets activated and it's bought, and the rest of the things which would get cancelled. For example, a trader places immediate or cancel order for 100 shares of NMDC at Rs 145 per share. 50 shares are available and executed, whereas the other 50 shares will be cancelled.
Apna course. Get smart. Get ahead.